So imagine crypto as this huge, kind of unpredictable ocean. A lot of people just dive in, right? Hoping to catch one massive wave with a single bet.
Yeah, you see that a lot.
But what if there was a smarter way? A way to, navigate those currents, maybe ride a few different waves, find some hidden spots, and protect your boat from storms.
That's the goal.
That's really the aha moment we're aiming for today. We want to get into mastering crypto portfolio diversification. Our mission really is to unpack how you can manage risk strategically and maybe maximize potential returns in this pretty dynamic world, all by just spreading your investments intelligently.
It sounds simple, but the execution matters.
Exactly. And we've pulled insights from quite a few places, trusted platforms like Kraken, CryptoMat, Caleb and Brown, and others, just to give you a really solid picture.
Good sources.
So let's just cut to the chase. When we say diversified crypto portfolio, what are we actually talking about? What does that really mean day to day?
Okay, well, simply put, it just means intentionally spreading your investments. So across different crypto assets, various sectors within crypto, and even using different strategies.
Okay.
And the core goals, they're usually twofold. Manage that risk and, importantly, maximize your potential upside. Basically, not putting all your digital eggs in one basket.
Right. Don't put them all in one basket. I think most people get that instinctively. But crypto is so fast, so volatile. Why is this so critical here? Sometimes it feels like you should just chase that one coin that's mooning,
That's a really good point. And it's exactly why understanding the why behind it is so fundamental. We can break it down into, say, 3 core ideas.
Okay.
First, and maybe the most obvious one, is risk mitigation. I mean, if you put all your money into just one cryptocurrency, well, you're setting yourself up for potential disaster.
We've seen that happen.
Oh, absolutely. Countless times. A single project fails. Maybe it's a rug pull, a hack, or just the market turning unexpectedly, and poof, a concentrated portfolio can get completely wiped out.
Scary stuff.
It is. But holding a mix, maybe some Bitcoin, some Ether, definitely some stablecoins, perhaps DeFi tokens, even a few carefully chosen emerging altcoins, that drastically reduces the hit if any one of those assets tanks.
So it cushions the blow.
Exactly. There was actually a study looking at the last big downturn. Portfolios that had even just 10% in stablecoins saw, on average, about 30% less volatility compared to Bitcoin-only ones.
Wow, 30%. That's significant.
It really is a tangible difference.
So, okay, mitigating a single asset crash makes total sense. What else? What other risks does diversification help with?
Well, that brings us to the second principle, non-correlation. Now, we should be honest here. In crypto, a lot of assets tend to move together, especially when the whole market drops.
Right. Everything seems correlated then.
It often does. But strategic non-correlation isn't necessarily about finding assets that are completely independent. That's tough in crypto. It's more about finding ones that don't always move in perfect lockstep, ones that offer a buffer.
Okay, so maybe they zig when others zag, even just a little.
Sort of, like pairing those really volatile tokens with stablecoins, that acts as a cushion, helps absorb the shock from sudden market swings. Or maybe looking at utility tokens tied more to platform use than just pure market hype. It adds a layer of stability that, a purely speculative portfolio just doesn't have.
Gotcha. So it's not perfect independence, but finding things that react differently enough to give you some breathing room.
Okay.
And the third principle?
The third one is maximizing upside. And this is where it gets quite interesting, actually. Diversification can act like a discovery engine.
How so?
Well, by spreading your investments across different sectors, think DeFi, NFTs, maybe smart contract platforms, gaming tokens, you position yourself to catch growth from multiple different areas of the crypto world.
So you're casting a wider net.
Precisely. You might discover an emerging sector or a specific technology that just takes off, maybe even outperforming your initial big holdings. It opens up opportunities you'd completely miss if you just stayed focused on, say, Bitcoin alone.
Pretty amazing, really.
Right.
How much risk you can potentially lower and how many doors you can open just by thinking beyond that one big bet. But, okay, knowing why is one thing.
Yeah.
Actually doing it, especially when the market changes so fast, that's another challenge.
Absolutely.
So how do we actually do this? What are the practical steps someone can take to build that diversified portfolio?
Okay, so the how really boils down to a couple of key things: strategic asset allocation and thoughtful sector exposure.
Right.
First, asset allocation. You generally want to think in categories. You'll likely want a chunk in large caps, your established coins, Bitcoin, Ethereum. They offer market leadership, bit more stability, relatively speaking.
Inventations.
Exactly. Then stable coins. Things like USDT, USDC, these are absolutely critical for liquidity and for tamping down that portfolio volatility. They're like your safe harbor in a storm.
Mm-hmm.
Next up, you might consider altcoins. These are the smaller, potentially higher growth coins like Solana, Polygon, Avalanche. More exciting upside? Maybe, but definitely higher risk too.
Yep.
And finally, think about sector tokens. Investing in tokens that represent different, distinct slices of the crypto pie. So for DeFi, you might look at Uniswap or Aave. For NFTs, maybe ApeCoin. For scaling solutions, layer 2s like Arbitrum, Optimism, gaming, maybe Axie Infinity.
That breakdown makes a lot of sense. Different types of assets doing different jobs.
Yeah.
So once you have those categories in mind, how do you avoid accidentally putting too much in one area anyway?
Good question. That leads straight into sector diversification. It means consciously spreading investments across those different sectors. We mentioned DeFi, NFTs, smart contracts, infrastructure, whatever they might be.
So don't just buy 5 different DeFi tokens and call it diversified.
Exactly right. That reduces your risk if one particular sector hits a rough patch. And related to that is the need to avoid overconcentration. You really need to set limits on how much of your portfolio sits in any single asset or any single sector.
What sort of limits are typical?
It varies based on risk tolerance, but the principle is key. Prevent huge losses if one area just tanks. Many people have learned that lesson the hard way. It's really just about spreading your bets properly.
Okay. And what about people who are a bit more experienced or maybe want to get a bit more sophisticated with this? Are there more advanced strategies?
Oh, definitely. For more advanced investors, there are several tools. Dollar cost averaging, or DCA, is popular.
Right, investing fixed amounts regularly.
Yeah, exactly. Invest the same amount at regular intervals, weekly, monthly, regardless of the price. It helps smooth out the bumps from volatility over time.
Okay.
Then there's portfolio rebalancing. This means periodically, maybe quarterly, maybe twice a year, adjusting your holdings back to your target percentages.
So if Bitcoin shoots up and becomes too much of your portfolio,
You would sell a bit and maybe buy more of something else that's underweight to get back to your plan. Some also look at geographic diversification, considering projects from different parts of the world to reduce regulatory or local risks.
Yeah.
And then, for the really advanced folks, you might see the use of derivatives like options or futures. These are complex financial instruments, but they can be used to hedge risk or get exposure without directly owning the underlying crypto. Definitely not for beginners, though.
that's a pretty comprehensive toolkit. Okay, theory and strategies are great, but to make this really concrete, maybe walk us through what a diversified portfolio might actually look like. A hypothetical example.
Sure, let's sketch one out. Imagine a portfolio structured with a mix like this. For your major cryptos, you definitely have Bitcoin and Ethereum. They provide that core stability and market leadership.
The anchors.
Right. Then stablecoins, USDT, USDC, maybe DAI, crucial for liquidity, that volatility buffer we talked about.
Got it.
Moving into sectors, for DeFi tokens, you might include things like Uniswap, UNI, AI, AAVE, maybe Maker MKR. That gives you exposure to decentralized finance.
Okay, the DeFi space.
Then layer 2 solutions like Polygon, Memanic, Arbitrum, ARB, Optimism, OP. These are important for exposure to scalability and innovation, making blockchains faster and cheaper.
The tech improvements. Makes sense.
For emerging growth areas, you'd want some NFTs or gaming tokens, maybe ApeCoin, APE, or Axie Infinity, AXS, tapping into those newer trends.
Higher risk, maybe high reward there.
Generally, yes. Now, some people might even allocate a tiny slice to meme coins like Doge or Shiba Inu. But, and this is but these are extremely high risk, pure speculation really, not for the faint of heart, and should be a very small part, if any.
Good warning.
And finally, you might hold governance tokens like UNI or AAVE again, which often serve a DeFi purpose, but also give you voting rights on the protocol's future.
So you get a say in how things develop.
Exactly. Now, obviously, this is just an example, and it raises a really important question. How do you take this sort of structure and tailor it to your own specific situation, your goals, your risk appetite?
That's a fantastic breakdown. It really helps visualize it with actual coin examples. So for you listening, whether you're just starting out or maybe looking to tweak your strategy, what are the absolute key best practices, the things we should all really keep front of mind?
Yeah, the core takeaways are pretty straightforward, but they are critical. First, define your goals and your risk tolerance before you invest a single dollar.
Know thyself.
Absolutely. Are you aiming for aggressive growth, capital preservation, something in between? That guides everything. Second, research every asset and every sector thoroughly. Don't just chase hype on social media.
Do your homework.
You have to understand what you're buying, the tech, the team, the risks, the competition. It's non-negotiable, really. And third, critically, regularly review and rebalance your portfolio.
Don't just set it and forget it.
Definitely not in crypto. You need to check in, make sure things are still aligned with your strategy, and adjust as the market landscape inevitably changes. Things move so fast, your strategy needs to be agile too. Look, at the end of the day, a well-diversified crypto portfolio isn't just about playing defense. It's actually a smart, proactive strategy. Yes, it helps cushion against that crazy volatility or reduces the risk of catastrophic losses, but it also positions you to actually benefit from growth across this incredibly dynamic and rapidly evolving space. It's about being strategic, not just reactive.
That sums it up perfectly. The crypto world, yeah, it's always going to be moving, probably always volatile to some degree. But with tools and principles like these, you're not just getting tossed around by the waves. You're actively shaping your own journey through it.
Well said.
So think about that. How do these diversification principles empower you, not just to survive the crypto markets, but maybe, just maybe, to actually thrive within them? What steps are you going to take next to start mastering your own crypto portfolio?